Thanks for joining us for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start with our chart of the week here, and we title this More Stocks Beating the Index. So what this chart is showing is the actual percentage of individual constituents in the S&P 500 index that are outperforming the index itself. And you can see that in a lot of years, it is below 50%, but it was very low in the prior 3 years. Really, since the launch of ChatGPT, the market's been rewarding the big hyperscalers that are really AI enablers. And you can see that the percentage of stocks actually beating the index was around 30% over the last 3 years. So that's a very challenging environment for any sort of active investment decisions when those large companies are the leaders. But now we can see that we're upwards around 2/3 of constituents so far this year are beating the index itself. We've seen a very rotational move in the market where investors are rewarding the other segments of the market and not only rewarding the big hyperscalers. This is a theme that we suspected could play out this year, and we have thus far seen it in action. So when we look at year-to-date returns, it really shows the same thing. We can see that different asset classes continue to lead, and international stocks were leaders last year. Small caps started to perform better in the last 6 weeks or so of the year, and those trends have continued through to this year. So the S&P 500 is up 1.4% this year, but some of the other indices on here, small caps are up 7.6%, international emerging markets are up 7.3%. And international developed markets up about 5.75%. So this has been an interesting trend. Certainly, or the rotational market has continued on, and a lot of that does have to do with valuation, and we'll talk about that a little bit later. But the large cap U.S. stocks are awfully richly valued here, and some of these other segments are more attractive from a relative valuation perspective. So even though those big US stocks are growing earnings still at a very respectable and quick rate, the expectations for those companies are sky high, as evident in their relatively rich valuations. So turning to some macro ideas, our friends at Ned Davis Research maintain this table on inflation that kind of shows different levels of inflation and the effect on productivity, economic growth, market returns, the average valuation on the market, and long-term bond yields. And all of these things interplay with each other. So when inflation is low, bond yields tend to be lower. That helps boost the valuations for stocks, and stocks tend to do better. In that environment, there's a wealth effect that's created. So it shouldn't be surprising that economic growth is better as well in those environments. So when you've had inflation rates that are below 1%, which doesn't happen often, markets and the economy have responded quite well. But even I'll point you to that second row of 1 to 4%. Economic growth has been solid. Stock market returns have also been solid. Your average valuation has been a bit lower, but still 20 times. And bond yields have been around 5%, which is really digestible by the market and the economy. It's really not until you get above 4% inflation where it really starts to be a drag on economic growth and on market returns, and bond yields are notably higher. So I think inflation is going to be stubborn here. It's going to be difficult to get to 2% or below, which is the Fed's target. But it doesn't look like inflation is running anywhere north of 4% anytime soon. So that should still support economic growth and the stock market. More so, the Fed has a dual mandate between inflation and employment. More so, we'd be more worried about the employment side of it. So here we're showing the unemployment rate in blue, and you can see that it has been climbing for the last couple years. And that correlates really strongly with the Conference Board's survey data, in which they ask survey participants if jobs are hard to get or jobs are plentiful. And so you can see that spread in the red dashed line here, and it shows that the amount of people saying that jobs are hard to get versus jobs are plentiful has been rising pretty strongly. And historically, that would correlate to an unemployment rate of 5.6%, not 4.4 or 4.5%. So there is potential upside pressure still on the unemployment rate, and we have seen that in some weak employment data from ADP and jobless claims and some other sources, the layoffs that we've seen thus far. Now, the good news is, from an economic perspective, there are some potential positives coming down the chute. Tax refunds should be higher this year. We've seen manufacturing surveys start to perk up, as well as the housing market. So it really is just kind of a race here for consumers if we can keep the labor market solid for now, while some of these more bullish things for the economy start to play out. And we can see that in consumer sentiment. So the University of Michigan Consumer Sentiment Index actually did tick higher in its latest update. It's still low by historical standards. But one of the things that we would note, so we show the actual index in orange in the middle clip, but then we show the year over year change in light blue in the third clip. And you can see that momentum, that negative momentum in consumer attitudes has been starting to subside. So that is potentially also a sign of green shoots here from an economic perspective. If consumers can gain some more confidence, that could be a positive for spending as the year goes on and for corporate earnings. Now, we did talk about this rotational market. From a trend perspective, we still give the bull market the benefit of the doubt. Here in orange in this bottom clip, we're showing one of my favorite indicators from our partners at Ned Davis Research. They call it Big Mo Tape Composite. And really all it's doing is telling you the percentage of individual sub-industries that are in uptrends. And we can see here that 71% of sub-industries are in uptrends. So even though the cap-weighted market index has been somewhat lackluster this year, a high percentage of sub-industries are in bull markets, and that's supportive of the bull market itself. Now, thinking a little bit longer term, I did mention valuations are challenging for large cap US stocks. This graph here shows 10 years after, on an inflation adjusted basis, what your range of returns have been coming from different places of valuation. So starting with quintile 1, that's the area that's the most extremely undervalued historically. You can see a very tight range of inflation adjusted returns of 10.2% to 15.3% over the next 10 years, with a median of 12.4%. So that's been the strongest zone. You can also see that quintiles 2, 3, and 4 are pretty much just noise. The range of outcomes is positive in all cases, and the median returns are pretty similar. But where things start to get a little more interesting is when you're coming from the extremely overvalued quintile, and that's where we are today. Valuations for large cap US stocks are in that extremely overvalued range. And that's not to say that you can't possibly have strong returns 10 years out. There's been a case that's seen 16% per annum returns 10 years after an overvalued reading like this. But you've also seen negative 6.5% annualized returns over 10 years on an inflation adjusted basis. So the range of outcomes is much wider, and the median returns are only 2.3% after adjusting for inflation. So we would suspect that it could be a more challenging environment in the next 10 years for large cap US stocks. And perhaps counterintuitively, in periods where large cap US stocks have struggled over a period of roughly 10 years, small cap stocks have tended to outperform. So here we're showing the red bars in the top show secular bear markets. Those are periods of time, long periods of time, where large cap US stocks struggle. And the green shows secular bull markets. And those are long periods of time where large cap US stocks do very well. And then that blue line shows small caps relative to large caps. So when that line is on the way up, that means that small caps are doing better than large caps. And when it's on the way down, that means that large caps are doing better than small caps. And you can see a fairly consistent pattern that small cap stocks have tended to outperform in those periods where large cap stocks are struggling from a longer term perspective. So we can't say with certainty that we're entering that environment right now, but the evidence is starting to build, which makes us take a tighter look at small cap stocks. So here, our closing thoughts for this week. Stock market trends have broadened out, and that's generally a good thing, but you do have to consider what it is that is performing well. And it's been a little more challenging for those large Magnificent Seven stocks this year over the last few months. So we still want to give the bull market the benefit of the doubt. Most sub-industries are in uptrends, but it is becoming a more selective market environment. Now, small cap stocks in international markets have continued to be leadership, and that's dating back to last year. And both of those asset classes do remain attractively valued relative to US large cap stocks. Now, we look at some macro things. We looked at inflation, and though inflation does continue to run above Fed targets, historically anything sub 4% on inflation has been consistent with solid economic growth and stock market returns. More so, we want to take a look at the labor market, and it's not falling apart, but it does continue to weaken. The difficulty is showing up here in the form of consumer sentiment, but it does appear that downward momentum and confidence has slowed. So that's something that could be a positive for the economy and the equity market as the year goes on. Now, valuations do suggest that the next 10 years could see softer returns here in US large cap stocks, but there is a wide range of potential outcomes. Historically, small caps have been useful diversifiers in those sustained challenging periods for large caps. So that's what we have for you today. And as always, I want to thank you for joining us and wish you a terrific week ahead.